Good afternoon and welcome. Today we'll be taking a look at global financial markets and investing related topics with a specific focus on April of 2020. So I'll get started with a few words from my friends in the compliance department. This call is for informational purposes only and may be recorded. Statements made during this call are the opinions of the speaker and are subject to risk and uncertainties, some of which are significant in scope and by their very nature beyond the control of WealthFactor. There can be no assurance that such statements will prove to be accurate, and actual results in future events could differ in a real way from said statements. Historical results are not necessarily indicative of future performance. Just to get us kicked off, for those of you who do not know me or don't know me well, my name is Bill Woodruff. I founded WealthFactor in 2017. I have over 20 years of investing related. That really started out prior to the tech bubble bursting in the late 90s. My investment career is diverse. I've done trading for a hedge fund. I've done manager research and due diligence across a variety of manager types. I launched and managed a mutual fund as well as other fund types. That mutual fund business line was acquired by a public company named Fortress Investment Group. And all of that has led to WealthFactor. So WealthFactor is a Lake Oswego-based investment advisor. We provide custom plan-focused investment advice. We offer that service through managed custom portfolios, predominantly index-based. Our client accounts are held in their individual names at a third-party independent custodian. We charge 0.35% on assets for our full investment advice service up to 10 million, and then 0.1% thereafter. We also offer a advice light service, which is our direct indexing. Investors are able to build their own portfolios with that with our direct indexing technology as the backbone. So to give maybe just a quick top level feel of how we think at WealthFactor, our philosophy we call RiskSmart, and there are three key aspects to RiskSmart. Being portfolio smart, or another way to think about this is being structurally efficient. And for us, that's really about avoiding things like picking and timing. It's my belief that it's difficult, if not impossible, to outperform indices or markets gross of fees. And then once you add layers of fees or increased fees, the probability just continues to go down from there. Another element is avoiding layers as well as complexity. I believe both of those things lead to additional fees and costs and ultimately increased risk taking, which is in nobody's interest. The next element is fee smart. So we charge 0.35%. That's the basis for base level of cost or fee. And then by utilizing index-based investing, we're really not layering on a dramatic additional amount of costs or fees. And so being fee smart or fee efficient, it's my belief that it makes sense to pay for investment advice and investment related services, but after a certain point, those increased fees and costs will start to detriment to the probability of success. And then the last element is tax smart. And so by our direct index based investment allows for a significant amount of individual account specific tax optimization, whether that's through strategies such as gains deferral or specific tax loss harvesting strategies. So what am I going to go through today? Well, April was a month that I think a lot of people weren't expecting. Q1 was clearly a surprise as well in a lot of ways. In terms of our change to our lifestyles and in isolating, and then the corresponding clear impact to the global economy and the U.S. economy from those forced isolations. So in April, we saw the markets snap back dramatically, and I hear a lot of people asking the question, why is that happening? Where it's clear that there's going to be real issues going forward for the economy. So today I've identified 5 different elements I'm going to spend some time on. So the first element, which is persistent in equity markets, is markets move and price things in very, very quickly. And perhaps there's a case to be made that's happening faster than ever. And that certainly can be, there's certainly some evidence that might point to that, at least as a point in the first quarter where we saw the most rapid decline in prices historically. So the second element of why was April such a strong upward movement, and why do we see such a strong upward movement in prices? Swift action by the Federal Reserve Bank. Number 3, swift action by the federal government. Then 4, we saw, especially after the first week or so of April, evidence that suggested that social distancing practices were in fact flattening the curve and perhaps reducing the extreme negative outcomes that were feared in the first quarter, the end of the first quarter for the coronavirus. And then lastly, 5 also was supportive to price increases in April, was optimism that there might be a cure or vaccine for the coronavirus, ultimately leading to maybe a reduction in the fear or risk that we might have this be a perpetual challenge or issue. So the most important one here, though, for me, is when equity markets declined 30+% in the first quarter, that was pricing in an incredible amount of negative future potential, and so that unwound a bit as we saw prices go back up. And then lastly, I'll look at today performance. I consistently believe that we shouldn't read too much into short-term moves in prices. And so I typically, whenever I share performance information, will look at it in a longer-term context. Okay, so I'll start off with swift action by the Fed. So the federal government's actions really took center stage in the media and most people's focus. But the Fed did its part and did so really quickly, restarting unlimited asset purchasing programs and including assets that it did not include in the financial crisis, most notably ETFs for corporate investment grade bonds. And so, as we look at and try to answer this question of, why was April such a strong period? Well, things were very scary at the end of the Q1, and then all of a sudden, in a very short amount of time, there's a significant amount of support that's coming behind asset prices in general. And so, the unlimited asset purchasing program certainly leads the way here. But they're restarting TALF and other various different facilities to support financial markets. And then also, another thing that's worth noting, and it's not necessarily Fed specific, is that the average bank or balance sheet is in far better condition, or was in far better condition going into this, whereas the banking area or sector of the world was really at the root or cause of the problems for the financial crisis. So different situation. There's really no lag in response, unlike the financial crisis. So number 1, swift action by the Fed. Swift action by the federal government. And so, I don't know if this is the right acronym or not, but it's kind of, there's a clear potential interruption to growth and the federal government steps in with an enormous amount of financial support. Of course, that's going to be clumsy. You can't do something with an incredibly complex economy on very short notice that's not going to have some issues. And there's been some missteps, but generally, $2.4 plus trillion being injected into various different elements of the U.S. economy is going to be supportive of price in riskier assets in general, and supportive of the economy, at least in some way in the short term. It's to be determined what the long-term impacts of this sort of thing are. But I think the point that the thing that we might be observing over time, and it's just 2 data points, I guess, so far, right, with the financial crisis and now this coronavirus-linked situation, is it's probably a net positive for whether it's the Fed or the federal government to step in and be that backstop to make sure our financial systems continue and we remain confident in our system, and so that we can go and do what the U.S. has always done, which is go out and innovate and work hard. And so there's some additional data in here that's interesting. Puts that amount of stimulus into context relative to GDP. So 2.4 trillion is approximately 12% of GDP. That's an enormous amount. And then, another on this top right graph, I think is pretty interesting. Once you get past 2020, these are forecasts, right? Which there's always going to be some uncertainty around that. But that shows the deficit levels considering this incredible amount of stimulus. And then on the bottom graph here, it's showing some context around estimates, future looking, for what debt looks like on a relative to GDP basis. And so these elements may have an impact on these short-term fixes. So the point number 3 is the coronavirus curve flattening. And so again, markets move really quickly. And so in the tail end of the first quarter, they were pricing in some really scary outcomes for the coronavirus. And so after the first week of April, as the pace in which the coronavirus number of confirmed cases and fatalities started to flatten and perhaps even decline to some degree, that was a relief to markets and asset prices in general, was treated as a positive. And so, again, markets price things in really, really quickly, and it really builds on the case that investors should attempt to avoid making decisions in the short term from an investment perspective and relative to how they think about the future, largely because of how fast asset prices are factoring in the information that we think we know. So the last element I'll spend some time on today is looking at some of the returns. And the biggest thing that I think that's worth spending time on is the continued divergence. And it's been 10 or 12 years of what is a factor or style-based divergence in prices. And so a lot of focus is on the S&P 500 or the Dow Jones. Well, those are really a subset. While they're the largest companies and represent the largest parts of the U.S. stock market, there really are quite a few other elements and thousands of other companies that aren't included in that. And so what we've seen is large and growth-oriented companies really snap back really quickly from a performance perspective. And if you look back over the last 10 or 12 years, those are the sorts of companies that really led the very strong performance. And we continue to see, whether it's, and if you go to the opposite end of that factor spectrum to small and value, you see small and value really lag over the last 10 to 12 years. And then, also is still, negative significantly despite what was very strong performance. And so this top left group of data here, it shows the performance for April, even though it's listing quarter to date. April is the entire second quarter so far through the end of April. And you can see there's a strong recovery across the board, but you can see even including that recovery where large growth is almost back to even, large blend, which is a better representation of the S&P 500, is still down almost or just about 10%. Other areas of the market are notably off quite a bit more on a year-to-date basis, and that's, there's a logic behind that, right? Where smaller companies are not going to have the significant economic resources to continue, or more of them are going to come under strain or stress in a prolonged period where there's a reduced or eliminated amount of economic activity within their areas. So I persistently don't think investors should focus too much looking back on performance. I think that the highest probability of success is by attempting to ignore this information. Can we draw some longer term conclusions? Perhaps. More so, I think that's just reminders of what not to do. And as I think back on the last 20 plus years, really investors have been rewarded by not chasing after what did really well yesterday. So if anything, I'm looking at a portfolio today and saying, I want to be neutral in terms of my growth, my large growth versus my small value. And it's not the time to be ignoring the areas that perhaps haven't performed as well in recent future or recent past. Well, I appreciate you guys tuning in. I'm going to intentionally keep these monthly updates short. I continue to offer a weekly refocus, which will provide some interesting insights in terms of how I think about the media and Wall Street and the way that they position information, as well as I'll continue to kind of provide data, graphs, and information that has a long-term orientation to it. So at this point, I am pleased to offer an opportunity to ask questions. And to do that, there are two ways. First, I'm going to unmute all lines. And if you don't have a question, then feel free to remute your line, but all lines are now unmuted. And then also there is an opportunity to, and I'm just pulling up my question and answer window here, to ask question, type in your question as well. So for those of you who joined, I very much appreciate you taking the time, and feel free to, okay, so let's see, I've got a question here. Allow to talk. Okay, so I believe I have a question. Trying to unmute the specific line. Apologies for my, okay. Are you there? Do you have a question?
Yes, last week you mentioned that you work a lot in ETFs. Do you have any particular
I believe that you're speaking, but I'm not able to hear you, which might be just a problem on my end. Hold. Okay. Sorry about that. Can you ask your question again?
Last week you mentioned that you do a lot with ETFs and index funds and so on. Do you have any particular ones that you tend to prefer?
Okay, I think I got your question.
The other side of that is that you may not want to say that on the public thing. So, but I started to ask you that at the end of your last presentation, and you clicked off faster than I could get it done. We're at
Okay.
a,
So I heard your question. I have continued to have technical difficulties with this Q&A, and I apologize for that. But your question, just for me to paraphrase, is do I have any specific indices or ETFs in which I recommend currently? And so the answer to that is I try to avoid picking and timing at all times. I believe that it's an exercise that isn't likely to be useful and is a very difficult one to be successful in. I mean, if I were to have a preference or a bias, we saw we saw growth outperform in the 90s. We saw value outperform growth from 2000 to 2008, and now we saw growth outperform from 2008 to current. If anything, I like things that are not as, it may look more attractive on a relative valuation perspective, and so I tend to prefer value over growth today. But with that said, when I build portfolios, I try not to let my own personal beliefs or views influence how I build portfolios, and try to stay disciplined in my implementation. And so, making sure, and so how I might treat that from an investment perspective is making sure that I stay balanced and don't allow a portfolio to get overly growth oriented. So, trying to take that to a specific ETF or an index. I like multi-factor based ETFs. And so, while this isn't necessarily a recommendation to go out and purchase this specific ETF, if I were to try to gain exposure to smaller companies that have a value orientation to them, one fund that I like, and so I'm tying in small and value at the same time here, two areas of the market that haven't performed as well as others in recent months, years, or even the whole prior decade. The ticker symbol for the particular ETF that I would use is S as in Sam, M as in Mary, L as in Larry, F as in Frank, which is a ETF by iShares that is multi-factor in how it's constructed. So I do, and there are four factors that are used in how that ETF is managed. It's ultimately an index that's put together by MSCI. But value is one of the four factors that goes into that. So appreciate your question. If you'd like to connect more on that particular topic offline, I'm happy to. When I've asked questions, when you asked questions and when I answered them, I was getting a reverberation and a delay. And so I'm going to wind down the Q&A, and I apologize for that. I appreciate the question, but if anybody has any future questions, I would recommend either shooting me an email at the address here, or don't hesitate to give me a call. I'd be happy to discuss.